All right. Well, I think we are. I think we are ready to go here for our first set. We'll let other people kind of slowly trickle in. Welcome everybody. My name is Pat. I'm the CEO of Bitwave. Super excited to be here chatting today. This should be very fun. The title of today's webinar is Your Finance Team's Survival Guide to Digital Assets. So I tend to think of, finance is well, when I'm talking to people, one of the things I say is that when we built Bitwave, and we'll talk about what Bitwave is and how we fit in all this, like when we built Bitwave, the person who I tend to think of the most, the person who I wake up every day thinking about, tends to be the bookkeeper, because there's this poor person out there who got into bookkeeping because they like numbers, they like finance, all that kind of stuff. And then one day they woke up and like this ton of bricks was dropped on them that is digital assets. And like they are the people that got hit almost worst by this entire crazy digital asset thing that we're all doing here. And so there's this part where like, for people that are like the engineers of the world and the finance types, like the investment banker types, who are out there doing fun stuff, and they're just like going into different protocols on the blockchain and YOLOing into DeFi and buying random coins like Shiba, like they're kind of doing the fun side of all this, which is just whatever the hell they want. And then you have people on the other side who are kind of like trying to follow behind them and clean it up so that you can get onto your books and all that. And that ends up being such a difficult project. And so what we want to talk about today is really, Bitwave has built what we call the digital asset maturity model. It's a like 25-page 4-step guide for enterprises who are looking to adopt digital assets. And it walks through a bunch of different steps that you kind of go through. And at each step, it talks about the different considerations that you have to kind of work within. So today we're really starting on step 1, which is what we call the adopt step. And it's, for whatever reason, you ended up with some digital assets on your balance sheet. And you've got to survive it. So this isn't about adding value as the finance team. And I know that that's kind of a funny thing to say, but like later stages of the maturity model, we really do talk about how finance becomes more of a central part of your strategy. Finance becomes more of a value add, because finance could even become a bit of a revenue center, because if they're doing yield farming or staking or things like that, like finance actually starts generating profits and can do this other sort of stuff there. Early on, that's not really what finance is doing. Like your goal early on with digital assets is to survive the first like 6 months, make sure your books are good, make sure you're paying your taxes correctly, make sure no one goes to jail. And then after that, you kind of switch. So the topic today is really how your finance team is going to survive in this whole digital asset transformation world. So we'll start out with just kind of introductions. I'll walk through what Bitwave does and all of that. I'm going to spend a little bit of time just talking about the overall ecosystem. So this might be generally interesting. I'm not sure, we get a lot of people who come to Bitwave and ask questions about like, oh my God, are businesses really using crypto? And businesses are really using crypto. So I like to sort of talk a little bit about that and just sort of show off, who's using it for what and what the different ways that businesses can think about it. And then finally, the whole second half of the presentation will be point number 4 here, which is really just how you should be equipped for success and what you should be thinking about through all of this. This webinar, when we are finished, will be recorded and we'll share it out with everybody, so you'll be able to pick it up. And then our normal disclaimer here is that nothing on this webinar is tax or accounting advice. So basically, anything that you need to do, if you're going to be using digital assets, you need to have a very strong partner portfolio of companies that are working with digital assets. So whether that be some sort of outsourced CFO company, things like that, there are some great partners that we have that know digital assets, can offer you recommendations on digital assets, and they can offer you recommendations on tax and accounting as well. So that's the normal disclaimer. Be aware of that. So let's talk a little bit about Bitwave. Bitwave, we're the market-leading digital asset tax and accounting solution out there. And what I like to say is, especially for businesses that are using crypto. So we'll talk about that going forward, the difference between businesses that are using crypto and businesses that just bought a little bit and are kind of holding on to it. We're in market, we're doing great. We've got over 75 customers, and we work with everyone from large public companies like Greenwich Electricity, which is they're a public company in upstate New York. BlockCap is a public company now, through payment processors, DeFi protocols, L1 solutions, L2 solutions, all of it. And we have a great cadre of investors that we're super proud of on that side. I don't want to belabor the Bitwave point. We get to make a little pitch, so I'll make it. We handle a bunch of different things around digital assets. The way I like to describe it is that we sort of are everything back office that you might need around digital assets, we can handle. So everything from how you're doing your tracking, how you're doing your reconciliation, how you're doing your tax treatment, AR, AP, treasury management, and then we have robust reporting APIs and financial reports. So you'll hear more about this as we kind of go on, but Bitwave offers like a full solution around everything that we're talking about here. And then I'd be remiss if I didn't mention our product solutions team here, which is that we have a full solutions team that essentially helps with anything you hear me talking about today, especially this kind of roadmap stuff. Like, our CTO just bought crypto. What the hell do we do now? We have a full solutions team that can essentially help you plan strategy, help you plan internal processes, write process documentation if necessary, help you pick technology providers or accounting partners or tax partners. So if anything today that you're seeing from us piques your curiosity, please reach out, and we have a solutions team that can really help guide you. I like to say we can kind of be your spirit animal through this process that's adopting crypto assets for your business. So let's talk just briefly about today's digital asset ecosystem. I love this. This is like it's almost like hard to believe, because for people that are in the ecosystem, we see all this stuff every day. So it's not that it's surprising. It's just like, I know how much stuff is going on in crypto. But for someone who's coming from another business, or someone who's in CPG or whatever it is, you come to crypto, you might have absolutely no idea what is going on here. And it is remarkable how much stuff is happening. I mean, basically, this is sort of a high-level sampling of like 1/10 or 1/100th of the companies in the space. And it goes from everything from like stuff that's on the infrastructure side. The left-hand side here are companies like Anchorage or BitGo or NYDIG that are doing custody and infrastructure or wallet management, things like that are really early, basically like foundational pieces that you'll need. And we'll talk more about how picking a good custodian is a really important part of your digital asset maturity as you kind of go through it. There's hundreds of exchanges at this point. I mean, literally, and then we put Square in there because even Square now has the ability to do some amount of exchanges. There are these, the digital asset banks and payment providers. This is so interesting because there are these companies like BlockFi and Celsius where you can go to them, you give them some of your Bitcoin, they give you back a yield. They give you back 7% on your Bitcoin on a monthly basis. And it's just a place to stash your Bitcoin, but then you can also borrow against it. So if you go to Bitcoin, you give them 3 Bitcoin. You go to BlockFi, you can give them 3 Bitcoin, and then they will give you back, $100,000 as a loan. So you can actually do collateralized lending, all that sort of stuff. And then there's, within the Ripple space, there's all these cool things happening. You have within like the DeFi space, you have all these really cool things happening. You have Maker as a DeFi decentralized stablecoin. DM is Facebook's attempt at a stablecoin there. Gemini is doing a lot of stuff around issuing their own. They have their own stablecoin. Ripple as an L1. Tons of stuff there. Every investor at this point is getting into this stuff. So every investor is somehow touching crypto at this point, whether they want to or not. Like a lot of these guys almost got into it accidentally, where they like one day kind of like they bought a company or they did XYZ, and suddenly they are deep in crypto, and it's a pretty funny way to think about it. And then what we are not going to spend a lot of time talking about today is what's happening in the DeFi space. It's super exciting. It is foundational. It's revolutionizing finance, but that's really the next one. So the next webinar we're going to do is all about how to thrive under, not just how to survive, but how to thrive under digital assets. And that's where DeFi comes into play, because that's where finance becomes like a real value add part of your business, where they're actually helping you make intelligent decisions about everything that's going on in the world. All right. And then, of course, we'd be remiss not to put the SEC on there because they're getting involved in all of this stuff, of course. This is kind of a fun slide because it's about the last probably at this point, it's close to like 36 months since when we built this slide. But it kind of like just shows different ways that businesses are kind of getting into this stuff. A lot of the enterprise engagement with digital assets started with MicroStrategy. And MicroStrategy is a really important company to talk about here, not just because they were very foundational to digital assets in kind of like the broader world, right? Like Michael Saylor has obviously been a very active participant. He got deep into this stuff. They are really, really evangelizing crypto. But it's important to kind of look at the different people here who are in digital assets. MicroStrategy is in digital assets for a hedge, right? So Michael Saylor is a sort of a libertarian slanty guy. You can sort of learn from his writings that he's not a particularly big fan of the Federal Reserve and things like that. So he is really out there kind of he is making a bet on Bitcoin all around a inflationary hedge. Now that's fine. That's not a bad way to be looking at the world, but that's not really like a typical crypto asset use case. There are people who are just buying a little bit of Bitcoin and they're saying, look at inflation's at 6%. I'm going to hold some Bitcoin for a little bit of time to basically hedge against that inflation. It's the same as buying your corporate headquarters location. It's the same as buying a bunch of gold. It's essentially it's a treasury management strategy that is predicated on a belief that inflation would hurt raw money market holdings, and that's totally reasonable. A lot of the people you see here, though, are not just buying and holding; they're actually putting it to work. So Tesla's a great example of that, which is Tesla, was for a period was actually A, they did buy some, but B, they were actually accepting crypto to buy a Tesla. So you could go into a dealership and you could send them one Bitcoin and they would give you a Tesla for that. This is very different, right? This is a world that's a lot more akin to transacting in digital assets. And that's also when things get a lot more complicated. So we'll talk about this going forward, but like the difference between my treasury bought some Bitcoin as a hedge all the way through, we are getting money on a weekly or daily basis or a minute by minute basis that is revenue in crypto. They're very, very different postures that you as an accountant or you as a finance team really need to take to understand this stuff. PayPal, of course, started allowing users to both buy digital assets on their through their app, and then later added the ability to actually receive and send digital assets. That's important to notice because, first of all, PayPal then started taking fees in digital assets. So outside of if you are thinking about your business and you're kind of building up this world where you want to support digital assets in different ways, well, if one of the ways you're going to support that is allowing people to trade digital assets in one of your apps or allowing people to send them out, PayPal not just picked up kind of accounting requirements, which was, when they take a fee in digital assets, they had to recognize that. But then they also picked up compliance requirements. As soon as PayPal allowed someone to turn USD into crypto and then back again, they picked up what would be 1099B requirements in the US, which is basically cost basis reporting to their customers. Now, there's a lot of ambiguity around whether or not this is going to be enforced or when they're going to enforce it. But in the next year or two, everyone that allows you to go into an app and change that app, change money from USD into crypto and back again, will have to do cost basis reporting to the IRS. And they'll be doing 1099Bs. There's essentially, we've kind of arbitraged the regulation to the maximum extent at this point. There is essentially no chance that come 2 years from now, people will not be doing that kind of stuff. Going down the line here, other interesting stuff, my favorite thing on this was JP Morgan. JB Daimler came out in 2018 and just bagged on crypto. I mean, just bagged on it and bagged on it. And that's totally fine. But at the end of the day, then 2 years later, JP Morgan just slinks on in and starts up a whole blockchain group. So this is kind of the nature of this stuff, is that you tend, the very first time you see crypto, you tend to have this kind of knee-jerk reaction against it. You tend to be kind of well, is this a real thing? Like magic internet money. And then as you get deeper and deeper into it, and you realize sort of this idea that it's not that it's magic internet money, it is this idea that you are creating an API for money in a way that's never existed before. And what happens when you really do have 100,000 really smart engineers programming money? Well, that's what we've ended up with crypto. And I think most recently, there's just been a bunch of news from Visa and MasterCard. So Visa, this is my favorite, is that I don't think there's ever been a more successful marketing campaign than Visa. When they bought one NFT for 150K, they bought one NFT and suddenly, I mean, they got earned media on every single publication in the entire world had Visa's name splashed across the above the fold. I mean, it is incredible, like almost unbelievable. Good for Visa. MasterCard then saw that and decided to like, oh, we should probably do that also. And so they sort of followed into it as well. So this is kind of a random sampling of like what people are doing. Everything from treasuring Bitcoin as an inflationary hedge to providing services to consumers, taking Bitcoin as payment through actually buying and treasuring NFTs. And then Visa is obviously, I mean, Visa and MasterCards take all this, is obviously going to be enabling their payment networks to be able to take crypto. Now, what it really means to be a middleman in a peer-to-peer decentralized economy is not yet clear, but I think it's going to be fun for us all to sort of figure that out. So let's get into this a little bit. And this is, I always show this slide first because this is why crypto is difficult. Finance teams in general tend to think about digital assets. Tend to think about their teams. There's kind of 2 or 3 different roles that you have. You often will have a treasury management team that is responsible for like various treasury management activities around your assets, whether it's picking out banks, maybe choosing money market funds, maybe putting some stuff into mutual funds. Like you have a small treasury management team. You have your accounting team, which will have bookkeepers and CPAs and all that kind of stuff. And then you have your tax team, which might be one person internal, and then like a tax firm out of Philadelphia that comes in once a year to do your taxes. And so you have these 3 different roles that are kind of sitting there. At the end of the day, what is so difficult about crypto is that it basically takes those 3 roles and it smushes them together. And so whether or not you, at the end of the period, you end up having one person responsible for it all, or you end up having, 3 people spread across groups responsible, you end up in this situation where you need people to be working together in a way that they just haven't. And I like tax and accounting is a great example. Like, I've worked at a lot of businesses, and the tax and accounting groups don't tend to talk all that much. They might talk once a month during close. They might talk once a quarter when they're looking at like some tricky little issues. There might be a very ad hoc communication process. Crypto, you really can't do that. Like your tax team needs to be very, very close to your accounting team as you're doing all this stuff. So the example I always give is, let's say I decided to pay everyone who came to this webinar today 1 Bitcoin. Wouldn't that be great? So let's say I decided to do that. The first thing is I'm going to send you a Bitcoin. The moment that I send it to you, I need to fair market value that Bitcoin, and then that becomes an expense. So I guess we're going to call this a marketing expense. So I send you 1 Bitcoin, we go and we fair market value it. Today it's at $60,000, not at $40,000, but just shows like how much this stuff changes since I made this slide like 2 months ago. So I send you 1 Bitcoin and we're going to fair market value that $60,000. So that $60,000 has to hit my general ledger as marketing expenses, because that is a marketing expense. I want to write it off. Like that is what we need to do there. So I need to get $60,000 into my GL. That $60,000 is also the disposition proceeds from my Bitcoin. So I guarantee that I got my Bitcoin at less than $60,000. So whatever I got it at, let's say I got it at $40,000, I sell it I use it at $60,000. That $20,000 gap there is my gain or loss. So this one single transaction turns into both an accountable action as well as a taxable action. And the thing that's really important is you also need those in order for your books to balance. In order for either accounting books or tax books, and we can talk about all of that later, to balance, you need those numbers to actually line up. So you can't just sort of best effort hope that when your tax people look at your crypto transactions after the fact, they get the same numbers as your accounting team used. No, for your books to balance, you need your accounting team to pick up to use the exact same cost basis, the exact same fair market value as your tax team. And oh, by the way, because I'm paying you guys all of this, I also am picking up a compliance event. I need to 1099 you guys. Like you all just made $60,000 from my company. In US tax law, I need to send you a 1099 NISC that says what I paid you, which then, if in order for everything to really balance, needs to line up with that same fair market value of the coin that I use. So you get in this mindset where a single action, a single transaction that took someone from your ops team 30 seconds to do. I mean, literally, like me sending you guys all that much money would be, like 15 minutes of work. Somebody that did that has picked up 3 completely segmented, and especially at traditional finance groups segmented, but 3 totally separate compliance obligations from your business. So I won't belabor the point, but this is kind of why what Bitwave exists to do is that we sit right in the middle of these compliance obligations. So essentially your tax, accounting, and then compliance, we sit right in the middle of those. We help bridge the gap between all of them. So we help integrate the blockchain transaction to your general ledger. We help track that cost basis so that when you dispose of that asset, we can calculate your gains and losses. And then we can help you do your 1099-Bs or MISCs or whatever you need to do for compliance purposes. So I think that's the last pitch that I have for Bitwave, the last hard pitch I have for Bitwave in here. But this is kind of like what we do and how we think about this problem, which is it's a combination of services and product, mostly with a little bit of services to kind of sit on top of it. All right, so let's get into it. Here's how we've broken down the digital asset maturity model. And you can go online today, bitwave.io/DAMM, to get the digital asset maturity model. It's a 25-page walkthrough and all this kind of stuff. Essentially, like level 1 is, we call it like ad hoc. And like level 1, the way to describe it is like, oh, damn, our CTO just bought a bunch of like Ethereum on his corporate credit card. What the hell do we do now? That's kind of like the starting point. And then all the way to level 4. And so like level 2 is like, okay, we're getting our processes in place. We understand this. Now it's not just our CTO. Maybe it's our CTO and a couple of product teams. Level 3 is like, hey, we now have like major revenue streams coming off of digital assets. That's great. Like we're recognizing revenue on a monthly basis. This is a major part of our strategy. And then level 4 is we as a finance team have actually matured to the point where we are helping you actually make money. We are helping with treasury management. We are issuing bonds. We're issuing debt onto the blockchain. We're going into crypto, DeFi protocols, all that kind of stuff. This is kind of the path you're going. It's a path from like a very ad hoc kind of like young process into a very defined process that includes like a 10-day, a 10-day close. So in the same way that like you would be hoping for your goal as a finance team is to do a 10-day close for the rest of your books. Same thing with digital assets. Like let's get a 10-day close for digital assets as all inclusive of it. So today we're really going to be focusing on step number 1 here. So level 1, and over the next few webinars, which we'll be doing every like 3 to 4 weeks, we have another webinar scheduled. We'll be getting into level 2, 3, 4, and beyond. This is really the very first thing, which is like just enabling digital assets. So there's sort of 2 paths that you get here. One is you got dragged into this, which is like, hey, our CTO just bought a bunch of Ethereum. What do we do now? The other one is like, hey, our CTO wants to buy a bunch of Ethereum. What do we do now? And so those are the 2 paths you might kind of get pulled into this step is. But what you're doing is you are essentially going from no crypto on your balance sheet to a relatively small amount of crypto. So if you're going from, if you're like MicroStrategy and you're going from no crypto on your balance sheet to $250 million of crypto, you want to really hightail it through a couple of these different like maturity levels, because you need to really have very sophisticated, handling for impairment and all the different things you're going to run across. But at this level, it's more like, hey, we could probably write this off. Like our CTO just bought some Ethereum. He bought a couple $1,000s worth. We could probably write this off right now if we wanted to as just a developer expense, and then just pretend like the crypto's not on our balance sheet. But we probably shouldn't. And I always tell this story, like I did this demo account where I had this like recorded demo where you can see me doing some just like silly DeFi stuff. And I think at the end of the demo, I had, I recorded this back in February. I had this wallet that was worth, I don't know, like $300 or $400. And it was just a silly little wallet. Like it didn't mean anything. It was essentially throwaway. I went back the other day and I was looking at this, and that wallet's now worth like $2,000. And it's just this throwaway wallet that I completely had forgotten about as a demo account. And this is the nature of cryptos. Like crypto tends to be, it's a deflationary currency. We're going through a major inflationary cycle right now. It's designed to go up in value. And so what you wrote off a year ago could be worth like $10,000 today. And so this line of like immateriality is not so clear when it comes to crypto. So in this case, like what you could do is you could just write it off. You could say, all right, our CTO bought this, we're just gonna call it developer expense, blah, blah, blah. But what you really want to do is you want to start getting your feet underneath you. Like you want to start figuring out, before you have to deal with 1,000 transactions a month, you want to deal with 10 transactions. And before you have to deal with 100 developers having crypto, you want to deal with one person having crypto. So the stage, this early enablement stage, is really, you're going from zero amounts of crypto on your balance sheet to like a relatively immaterial amount where your auditor's not going to get on you. You're not like, nothing's really going to change about your financials of your business, but you can start learning the processes and getting your sea legs around crypto without it being a really like, oh my God, we have to do it because we suddenly have $10 million on our balance sheet. At this stage, you're going to have a very constrained number of people. So this is one of the things that I always like talking about with crypto that people don't always necessarily think about ahead of time. Crypto is the unholy like child of a credit card and a bank account. It's a credit card because it is incredibly easy to spin up a digital asset account. Like spinning up a wallet is a 7-second process. I could spin one right up right now in front of you and be done before I finish this sentence. And getting funds sent to that wallet is incredibly easy. And using that wallet is incredibly easy. So at some of our more mature customers, we see hundreds, if not thousands of wallets. We had a customer come in yesterday who had 30,000 wallets. And so that's a lot more akin to a credit card. Like that's akin to like what you'd expect as like a corp card, an Amex corp card spread across your organization. But unlike a corp card, you don't have Amex as the middleman. You don't have a fraud department monitoring it. All of the assets are on your balance sheet and your responsibility. And so if one of your developers like has the example I just described, started with like $100 of throwaway, and that wallet ends up being like $3,000, they then go and start selling that and fly and like going online and playing poker with it or flying to Jamaica, whatever it is. Like you suddenly have a real control problem there. So it's a bank account because it is assets that you are responsible for. It's assets that you have to be monitoring, that there's no recourse if someone runs away with it. Like Amex isn't going to make you whole. But it's so easy to spin these up that it feels like a corp card. So what you want to be doing is you want to deal with that early. Like when you have 2 wallets at your organization, like when you have your CTO wallet and then maybe like an exchange account or maybe a custodial account, that's when you want to get your processes in place. Because by the time you have 1,000 wallets or 10,000 wallets, like you need to have mature processes. So the definitional side here is like at level 1 in the maturity model, you don't have that many wallets. You have a constrained number that you could kind of do it. You could kind of do a lot of the stuff manually if you had to. Although, of course, from Bitwave, I'm going to tell you want a tool for it, but like you could do it from a manual side. So the challenges you're going to run into, we'll talk about this a lot, but first and foremost is that the person who probably bought the crypto might have good familiarity with crypto. Like I always use the CTO as an example. That CTO is probably someone who lives and breathes crypto in their off hours. Like they might, if you have a CTO right now who's buying crypto to do a project for your company, he probably stays up till 3 a.m. trading Shiba, on weird exchanges and dexes and things like that. So the person who is getting into the asset might have high familiarity, but no one else in the organization does. No one else knows what crypto is. No one else knows what Shiba is. No one is aware of like what a blockchain is or like how these, you hear a lot of things about blockchains. Like you're like, oh, blockchains will get rid of accounting because everything is on this public ledger. Let me tell you right now, that is not the situation. Is that blockchains are in some ways making accounting more complicated. But no, so you are thrust in this position where you have to start upskilling a bunch of people in your organization. And that's where something like, so like training solutions from Bitwave or even Bitwave itself, which is really, we are designed to take a bookkeeper and upskill them to the ability to work with crypto. But they still got to learn this stuff. They got to learn the terminology. They got to like learn the symbols and they have to start thinking about fair market value and tax and accounting at the same time. You have no institutional knowledge. So one of the other things that you're going to run into is that there are, depending on your type of organization, there are a lot of forks in the road around crypto. Crypto up to this point, there's still not general guidance on a lot of different advice that you'll get from crypto. So a good example of that is impairment. So if you're a gap company, if you're trying to do gap reporting, then you should be impairing your crypto assets. If you're a private company and you don't care about gap reporting, all that kind of stuff, there's no need to do that. And so, once you've been doing crypto for 6 months, you will know if you need to impair or not. You will have talked to your tax advisors. You'll have talked to your auditors. Like, you will know what kind of things you should be doing. That goes for other stuff like ETH to WETH. There's this thing called wrapping Ethereum, where you take Ethereum and then you wrap it in like a different asset and it becomes WETH. They're worth the same amount. They're used completely interchangeably by people on the blockchain, but different auditors, some people want to see that treated as a trade. Some people want to see it treated as a containerization, not a trade. So different people, like different auditors, will have different experience with that. And so you as an organization you have to build up this institutional knowledge that says, like, yes, we do impairment, no, we don't. Yes, we treat wrapping tokens, no, we don't treat it as taxable. Like, you have to start building all that knowledge up. And of course, that takes time. It takes meetings with Deloitte. It takes meetings with meetings with Propeller, with your CFO, like whatever it is. Like, there are things that you end up having to meet with them on. And then of course, just the general stuff. The goal by the end of this is that at the end of the day, you will have a clear workflow for accounting for cryptocurrencies. You will start to have built up a team that is sort of focused on digital assets, and you'll start to build up knowledge on that team. And then finally, you'll start to have the ability to monitor your digital assets. And this is super important because, again, remember, at this level, you're monitoring like 1 or 2 wallets. At the next level, you're monitoring 10,000 wallets. And so, like, you want your dashboard ready today, not tomorrow. Like, you want to be thinking about monitoring your assets today before you have $10 million on the balance sheet. So let's talk about how we equip our finance team for success. This is the 4-step framework that we kind of talk about. Oh, I just love this. I don't know why. Adopt is really about, like, it's dipping your toes in it. It's like today we're gonna dip our toes. Expanding is like, okay, we have more people doing it. We're starting to build business processes around it. Maybe it's becoming an important part of our revenue streams. Like, maybe we're invoicing a lot of customers in this. The unlock phase is the phase at which you can start to think about how digital assets will change your business. So between the expand phase, the unlock phase, what I like to say is, there was a funny story. I don't know if it's true or not, but with these kind of stories, who cares if it's true? There's a funny story that the very first car that was ever manufactured, that someone painted like a horse head on it to kind of make people more comfortable with this idea of, like, cars moving without horses attached to them. I don't know if it's true. It doesn't matter. Where I kind of think a lot of people are with crypto today is in that horse head phase, which is that, like, what you're trying to do is you're trying to use a wire, but like it's wire 2.0. So instead of you wiring me some cash through my bank account, which is kind of a pain in the ass, you have to call your bank, you have to type some numbers, you have to confirm it. What I'm gonna do is I'm just gonna send you some Ethereum, and it's like the next iteration of wiring money around. I'm gonna send you some USDC. So that's kind of where people get into this. At the unlock phase is where you're not just kind of like the horse head. You're not just horse headed. Like, you're not just using crypto to replace current business processes. You're looking at new business processes that you can unlock through this. So that might be like, let's say you are Getty. I don't know. I always like pick on them because I think, when I think about who has the largest collection of digital assets, I mean, digital assets like a traditional sense, you think about the Getty or like the AP, the press company, or Getty as like the photography company. They have all of these digital assets. At some point, they will look at that and say, like, gosh, I wonder if we should start doing licensing of our digital assets through NFTs. I wonder if we should start, paying our royalties to our photographers through NFTs. There's this point at which you go from, like, I'm going to use crypto to replace existing processes to I'm going to create new business streams and new business models because of this idea that money is now programmable in a way that it wasn't. And that's really the unlock phase. And you have to be, at this point, your finance team has to be running. Like, during the adopt phase, you can kind of be crawling. The expand phase, you walk in. The unlock phase, you're running. And then the amplify phase, you're like hurdling. I don't know. I'll work on that analogy. But at this point, like, you have to really be up to do this because, like, you are now, because crypto is it's not immaterial. It is a major revenue stream. You're making difficult decisions about like, when do we recognize revenue that maybe has hit like a smart contract, but not our wallet? There are very, very complicated issues that come into play there, but there's so much money to be made. And there's this ability to basically get 3% back, like this 3% that you pay to Visa every year. You could just wipe that out because now you're going direct to consumers, direct to peers, and you're monetizing digital assets you might not have had before. A great example of that, like I had someone talk to me the other day about they managed an estate of like an old timey actor. Like it wasn't John Wayne, but it was you know some actor that had died a number of years ago. And they managed the estate of that, and he's like, we haven't done anything. Like we get residual checks, we do a little bit of licensing here and there. We haven't done anything for like for 10 years. And suddenly we've gotten 20 people reaching out to us about like how we NFTize, John Wayne or whatever it was. And it's a really good question. Like there are assets that you probably have on your balance sheet that you'll be able to change the nature of how you're exposing those to actually unlock new business lines. And then of course, Amplify is the last stage here is really where you go from unlocking and like getting kind of getting revenue to like, look at, we are entirely on the blockchain. We issue debt on the blockchain. We issue RSUs through blockchain transactions. We take our money and we yield farm with it to earn yields on it. So we're not just sitting in money market accounts. This is where like finance is really adding real value to the company by helping make money and enable these different use cases. We're talking about today is the adopt phase, but it's good to understand your full journey between all these different things here. So preconditions, I've already talked about this a lot, so I won't belabor it, but like, I like to say this, like, so you've got crypto on your balance sheet, like come sit down, pull up a chair, let's talk. You don't have any experience with crypto and you don't have employees, you don't have institutional experience with crypto, you don't have employees experience with crypto. First thing to do here is you got to get your team together. So this is one of those things that it's a funny way to think about it because it might be very obvious who the team is, but it also might not be. At the end of the day, like you need to get together people from the finance team. So you need to get together bookkeepers, the CPA who's going to be overseeing everything. You need to bring in your tax people. So you need to pick someone from the tax side of your house, even if that's external, who will be able to advise it. And then you need to bring in an auditor. Your auditor might not be at every single meeting, but your auditor will absolutely be very, very important for you to engage with on a day-to-day basis, on a week-to-week basis, when you have hard questions about, hey, we came across this particular weird staking transaction. Should we recognize this or not? Like, what do you want to see? How do we do provability? How do we do traceability? Like, you need to start putting the team, you got to start putting the team together. The other thing here is that like not everyone in your company, and I say this with love for everybody, not everyone in your company will be interested. Like there will be people in your company who are like, hey, do you want to be on our crypto tiger team? And they'll be like, hey, absolutely not. I think it's all a scam. I can't even believe the company I'm thinking about is we're getting into this. I'm going to quit. Like it's one of those things that like crypto is so, especially right now, it's so polarizing in some ways that you have to make sure you're getting people on that team who want to be there. Like people who want to engage with crypto, people who want to start thinking about this kind of stuff here. So you got to get your team together, and that's the most important thing. And you got to get them to buy into this. Like you got to get them to buy into this, and you got to tell them that they're going to be responsible. That they need to start working on kind of like the roles and responsibilities within their organization, things like that. And then you need to get them training material. So Bitwave, we have a cadre of kind of training processes we can run. We have a training, like one of our training modules is essentially like we'll come in, we'll send a little bit of crypto to a bunch of your employees. We'll walk them through setting up a wallet. We'll walk them through going into a DeFi pool and doing a trade and sending money to each other, like maybe even buying an NFT. We can kind of train you on that. But outside of us, and then we have like videos and stuff. Outside of us, there's YouTube. There's getting whoever bought the crypto into your company. There's getting them to do training. Like you first and foremost have to start building up the vocabulary and building the base knowledge that these people tend to have. The other bit of advice I often offer here is that in a lot of organizations, what people try to do, especially when it comes to bookkeeping, is they try to kind of peanut butter expertise across their organization. They try to spread it around. And there's really good reasons for that, right? Like if your bookkeeper who knows crypto really well gets hit by a bus and no one else knows crypto, then you are in kind of a bad position here. But that's not exactly the end all be all of these things, because at the end of the day, crypto is so tricky. It's such a new way to think about it. It requires new disciplines, new verbiage, new issues that you're seeing on a day-to-day basis. That in fact, the way I tend to recommend people really do build up deep knowledge in individuals, and then kind of start adding to the cadre of people who know crypto really well. So instead of trying to get all your bookkeepers to kind of know 1% of crypto, take one or two of your bookkeepers and really train the heck out of them on crypto. A great example of why this is important is that once you've seen one of the Ethereum blockchains, so there's a blockchain called Ethereum, there's another blockchain called Optimism. Optimism is an L2 on top of Ethereum. Once you get to know Ethereum, getting to know Optimism is really easy because they're exactly the same. They're very, very, very similar blockchains. They're just kind of slightly different instantiations of it. So if you've trained someone up on Ethereum, to get them to understand Optimism is easy. Same with some of the DeFi stuff. If you've trained someone up on a particular protocol in DeFi, getting them to understand another similar protocol is really easy. Whereas training two people up entirely, one person on Ethereum, one person on Optimism, and then training them both up on one person on Compound, one person on Aave, you lose a lot of that carry forward knowledge. So you really do, instead of and then each person has to fully learn what Ethereum is and fully learn what their particular variation of it is, then fully learn the actual DeFi protocol. So try to centralize that in a few people that you can really, really train up well. And then you take a train the trainers approach, because then they will go out and train other people around this stuff. Okay, you've assembled the Avengers, and now you're going to go to start to kind of adopt it. At a very, very high level here, what you will have some mechanism for which the digital asset is being held for your company at this point. Now it's kind of a funny way to think about it, but you will your CTO might be holding on a soft wallet on his computer. Your CTO might have a hardware wallet. He might be keeping it in an exchange, or you might have already even gotten to a custodian. All those things could happen here, but at some point, you need to figure out how you are tracking your transactions and balances. This is where, of course, Bitwave comes into play. But at this level, you might not need Bitwave. I mean, honestly, if you're just kind of dipping your toes in here, maybe all you want to do is you want to just use a block explorer. But no matter what, you have to be getting the full transaction set. You need to have a very repeatable mechanism to get your full transaction set and your balance on a weekly basis in order to view all this data. And so whatever you're using to export that, to get that from the blockchain, you need to start building those muscles up. You need to start building that muscle memory. So that could be, let's say a really, really simple example is your CTO bought, one Ethereum. He's keeping it on a MetaMask wallet on his computer, and then you just need to kind of track it. So what you would do is you need to get the address from him. So you need to start building up your set of wallets that you are monitoring. This is super important because you'll need to do this more and more. You build up you are going to be monitoring thousands of wallets over time. You need to start building up the processes for how you know what those wallet addresses are, how you know what blockchains there are, where you have your canonical list of wallets within your organization. You then would take that and you go to Etherscan and you put that address into Etherscan and you click the download CSV button, and there is the list of all of your transactions. Now, there's a lot of complexity there because he might have bought some tokens. There's a different tab for this. You need to also then do fair market evaluation. But that's the first step and that's sort of the most traditional crypto bookkeeping, the most traditional bookkeeping way to get to this is you go to a first party source, you download an Excel file, a spreadsheet, and then that is now your evidence for kind of going forward. So you need to find some way. Now, this is also where Bitwave comes in, is that we have a thing where you just put the address into our system, and then we pull all the transactions right up in front of you so you can kind of see them and go through them one by one. You then need to figure out how you're going to get those transactions into your general ledger and into your tax processes. Again, this is what Bitwave does, but even more on a more tactical basis, you have to remember every transaction is both a taxable event and a accountable event. So when he bought that Ethereum, you need to make sure you record the cost basis. You need to make sure that you're matching that to some expense that you're paying out. So it's essentially you're going to have some general ledger. You're going to have some general ledger asset account that is tracking your cryptocurrency assets. You need to do debit digital assets, credit, the expense account, whatever it is, to make sure that you are starting to track up this mechanism of how you're tracking those things. as part of that, you also are figuring out your fair market valuation calculations. So if you're using something like Bitwave, we offer that for you. If you're doing this manually, like you would basically take the transaction, go to something like Crypto Compare, grab a close price for that hour that the transaction occurred on, and then basically use that to fair market value it. So your spreadsheet starts kind of growing because it goes from like, all right, here's the transaction hash, here's the amount that was transacted as part of this. Now I'm going to add my exchange rate column, and then that's going to turn to my fair market valuation. That's now both in my spreadsheet. That fair market valuation is what's going to be my cost basis. So that's it. So you keep the spreadsheet around for tax purposes, but then also that now needs to be what goes into your general ledger. So you need to start building that process of going from either something like Bitwave where we do it automatically, or something like your spreadsheet where you're doing it kind of manually and get in there. And then finally, you need to figure out how you're doing traceability. So different people will have different requirements for this, but like once it hits your general ledger, it's going to be fair market valued. And so you're going to have the fair market value in the general ledger. An auditor needs to be able to come in and look at that GL entry, trace it back to whatever system you're using, whether it be Bitwave or your spreadsheets or Etherscan, whatever, and then trace it back from that system onto the blockchain directly. And so you need to make sure that you're getting the transaction hash in there. You need to make sure that you're getting all that data in there, and that whatever things you're doing there is essentially audit defensible. So this is why like that Tiger team you assemble needs to have someone from audit represented, because they're the ones who are going to have to come in there and sort of approve, like, yes, we agree with how you're doing this. No, we don't. Yes, we can audit this. No, we can't. So this is sort of very important step here is basically getting your audit processes, like getting one set of documentation. Like your first audit documentation is going to be 1 page long. Your second one will be 2 pages and then 10 pages. But like your first audit documentation, here's getting that done. And then you want to spend a little bit of time thinking about your GL for crypto. What I tend to say here is the very, very first time most accountants think about designing their GL for crypto, what they want to do is they want to create an asset account for each of their physical holdings. So I can't tell you the number of times we've gone to a customer that has other current assets, Bitcoin, other current assets, Ethereum, other current assets, like whatever. And that's not a bad way to approach it. And the alternative to that approach is so there's 2 alternatives we'll talk about, but like the one sort of first approach people have is an asset account per asset they're holding. The other approach people take is an asset account per wallet. So they'll have, CTO wallet, other current assets, CTO wallet, other current assets like, ops wallet. Both of those are good at low volume. So essentially both of those can work okay for low volume. We have customers that have, and the way I talk about crypto in general, there's that scene in Lord of the Rings. I feel like everyone's seen Lord of the Rings, so it's a good analogy. Like there's that scene in Lord of the Rings where like they're walking through the swamps, and like Sam and Frodo are walking through the swamps, and like Sam looks down, there's like a spirit in the water, and then like he starts like leaning forward, and then the next thing you know, he's like being pulled underwater by like all these like zombie things. That's kind of what crypto is. Like it's kind of this thing like one day you're like happily walking along, looking around, and you like look at something, and the next thing you know, you're like sucked into it, as whether it's as a business or an individual or whatever, because there's just so much interesting stuff to learn, so many interesting things to do. And so it tends to be the adoption cycle that we see for businesses is that you start with like 1 or 2 wallets, which is very, very manageable to have on your general ledger. And then very, very quickly, you have 10, 20, 30, 50 wallets. And suddenly you're having 50 different asset accounts. And every time you move money between them, you're booking transfers between these asset accounts. And your GL has all, and not only that, you're tracking gains and losses on a per wallet basis. So in order for you to true up the balance of an individual wallet with the blockchain, you need to book fair market value adjustments into that, like realized and unrealized losses. We can talk more about what that looks like, but like essentially you've gone from like, oh, we have 1 wallet, let's just make a GL account for that. So like, oh crap, we have 60 wallets, what do we do now? Same with tokens. So the exact same way, like once you start getting into DeFi, once you start doing NFTs, like every NFT is a different token. Every DeFi protocol is a different token. You're going to start getting into all these other things. And you go from like 1 or 2 accounts to like 10, 20, 30. We have customers who are holding, again, thousands of assets. So there's this part of your brain that you have to start getting your head wrapped around. This isn't like Forex. This isn't like Forex where there's like a natural limit to the number. There's a natural limit to the number of foreign currencies that there will be, right? There's 180 countries in the world. There will be 100. The max number of foreign currencies is 180. Like, I can work with that. That's not how crypto works. Like, there is essentially going to be an unlimited number of tokens, and your business will end up with an unlimited number of wallets. And so you want to design your general ledger on this. That's why what we tend to do is we tend to create a single primary ledger account and act entirely as a sub ledger. You can kind of fiddle around that a little bit and do cash equivalents, and like there's some other stuff you can do in there, but you want to design it. Like, don't let it happen to you. Don't let your GL process and design happen to you. Intentionally approach it, intentionally think about it. Ask your CTO like what his intentions are for your daughter. Like, what are his intentions for your beautiful GL? And start to think about like, what is going to change over the course of your business over the next like few years, and design your process in the same way, and design your GL in the same way. And then finally, start to define your tax and accounting processes. There is with everything with crypto, there's day-to-day bookkeeping. Like, it's just like any other thing you have, like any other place where there are transactions and money coming in, money going out. There is day-to-day bookkeeping. Figure out who's doing that. Figure out how they're doing it. Figure out what the process is. Do they close on a weekly basis, a monthly basis? When do they do their adjustments, all that kind of stuff. Like, start building those processes, building that muscle memory, get all that stuff going together, and then start running it. So part of the close, a well-orchestrated crypto bookkeeping process includes closing both your tax books and your accounting books on a monthly basis. And by the way, this is the first time you've heard me talk about separate books. If you are GAAP, you probably need to be looking at separate books because you need to be doing impairment versus just realized gains and losses. And so that ends up in a situation where you now have two sets of books, and you need to handle that piece of it. You got to figure that out. You got to figure out what process you're running. Depending on the business, maybe they want you to close on a daily basis. Maybe they want you to close on a weekly basis. Maybe they want you to close on a monthly basis. But you need to be doing that so you can, again, respond to kind of the requirements of the business and all that kind of stuff. And then finally, of course, the most important thing is you need to be matching up what is in your general ledger. You are reconciling from the general ledger to the blockchain. Now, if you're using something like Bitwave, you're reconciling from the general ledger to Bitwave, but then you're still reconciling from Bitwave to the blockchain. Like, just because you're using tooling, whether that be a spreadsheet or something like Bitwave, doesn't abstain you from the responsibility of checking that you have traceability. And setting up processes, set up sampling processes that say, hey, once a month, like one of our team members will go in and pick 3 transactions, trace them all the way back to the blockchain, and make sure that they make sense. So you start building that muscle memory, building that kind of tooling, building up the reports that you want to see, and then getting them into your kind of general reporting that goes up to the management team. So I'll pause there. We have about 5 minutes left. If you're interested in learning more, we have the digital asset maturity model. Just go to bitwave.io/DAMM or bitwave.io, and there's a big button on the homepage there to go and download it. But I will pause there and ask if there are any questions. And I'll sip my coffee. I'll sip my coffee while waiting for questions.
It doesn't look like we've got one in the Q&A. How many wallets is too many wallets?
Oh, that's such a good question. Essentially, the world is going towards infinite number of wallets. And I say that in a very silly way, but it's like asking a question like how many corp cards is too many. I mean, essentially, it's like 1 per employee. I'd say that's kind of a natural place, but where you'll end up getting is like some of the operation, like as your business grows, one of the operational security models that you'll use, if you really get deep into DeFi, one of the operational models you'll use is you will have lots of private keys spread around the world. And that's actually a good thing. Like you don't want to have one private key that has all of your money on it. You want to actually have more private keys. You want to have operational security around them. So, I mean, essentially, I think that in the long run, and then the other thing to keep in mind is that you filter through wallets. So people will use wallets for a little while and then they sweep funds away from it. And that's actually a good thing. So one thing that we haven't talked about that we'll cover in the next webinar is AR/AP processes around this. AR/AP around crypto is actually super interesting because there's this one issue, which is that the blockchain is essentially public. So if you are receiving, if you do AR in crypto, there is a very interesting question. Do I set up one single wallet that all of my AR, that all of my invoice revenue flows into? Well, you could do that, but that's kind of not a great place, because any of your customers can go look at the history of that wallet and then go and peek like, hey, this address, I don't know who this address is, but they're paying 150 USDC per month and I'm paying 1,500 USDC per month. Like, why am I getting screwed on this? And so there's even a part where actually every single invoice at some point might actually have its own wallet. Every single user will have their own wallet, and then you'll have chains of addresses. So really, the right way to think about this is to essentially assume that you will, over the long run, over the next like 5 to 10 years, you will have 50,000, 100,000 addresses that you're responsible for monitoring, and you need to build your processes up to kind of handle that level. All right, how do you think about when you should move from spreadsheets to a system, and also buy versus build? Great question. You should never build this. I've built this. It is insanely difficult to build. I would never in a million years build this unless I was building like as a software product here. So if I was building this internally, it's just too hard, because essentially what you are picking up from a maintenance standpoint, because when we think about a build versus buy decision, you essentially are thinking about a TCO versus, like, you're doing a TCO analysis, which is like, how much is it going to cost me to build this, and how much is it going to cost to maintain this versus how much is it going to cost to pay a vendor for this. So essentially, like, if you can get a guarantee, and this is where like this kind of stuff, like, if you can get a guarantee from your CTO that he will never use a blockchain besides Ethereum, maybe you can think about building something like this. Unfortunately, like, any guarantee you get from your CTO like that is a how do I say this? I wouldn't say it's a bald-faced lie, because he probably believes it, but it's just not the truth. It's not what's going to happen in the long run. So essentially, like, you will inevitably be integrating with other blockchains. Each blockchain is a relatively heavy lift to add support for your processes. So you end up in a situation where, like, 1 or 2 blockchains are okay, 3, 4, 5, and then things break, and then the blockchain changes or regenesis or whatever. You really want to be in a situation where you're offloading that. So the other side is, like, when do you have to go from a spreadsheet? That's, I mean, when I think about Bitwave's competitors, our number one competitor is Excel, like those bastards. That is, but it's fine. Like, honestly, if you can do it on a spreadsheet, you should. Like, if all you did is you bought Bitcoin a year ago and you're going to sit on it for 10 years and then you're going to sell it, don't use a tool. Like, don't do any of that kind of stuff. Do it all in spreadsheets. Save yourself the time, the money, the hassle, all that kind of stuff. When you get to like 2 assets, now you're managing 2 different coin inventories on a spreadsheet. That's when it gets a little bit trickier. When you get to like transactions, like recognizing, what I was sort of talking about in the spreadsheet, which is like recognizing revenue that also is coin inventory, that's where it starts to get more complicated. So like that's the other place where, like, you start to get it. You really, as soon as you're like recognizing transactions, that's when it gets real dicey on the spreadsheet. Amanda, that's such a good question. So the question is, how do we put the wallet as corporate asset instead of personal asset? What you want to do is you want, like, and actually the maturity model talks about this, is you want to set up processes where you really are being very clearly differentiating personal and digital and corporate assets. And there's some tooling that we have where you can actually go and force people to sign transactions with their private keys to prove that they still control their private keys. So I'll take a slightly different stance on your question, because it's a really tricky question. One way to think about this question is, like, what do you do if someone comes in with a personal wallet that really should be corporate assets? Like, your CTO bought some Ethereum, put it on he commingled that Ethereum with like his personal assets, but like really it's corporate assets. What do you do then? That's where, like, you absolutely, the first thing you need to do is get them to sweep that away. Like, you need to have very, very clear corporate assets, corporately owned private keys. You need to use something like Bitwave. Like, actually, part of Bitwave, we have an asset management system where you can manage ledgers and treasures and track like the private keys that the company owns. You need to set a process to really identify what you own. And then you need to get your employees to sign off on that. Because if you think that you own private keys and they think that they own private keys, and there's a dispute over like some coin that goes to the moon, gosh, what a terrible lawsuit to be involved with your employees. So you want to sweep everything to something to wallets that are very clearly owned by the corporation. And then you want to do the cleanup work. Like we've had to do this a few times. We have to go back and clean up work where you're like cherry picking transactions that are corporate transactions versus an individual, but like it is super messy. I mean, it's all the same. It's the same reasons you don't do this for bank accounts. Like you are piercing the corporate veil as soon as you commingle assets. So as a treasury department, you need to take a very, very hard stance that there is no commingling assets. All right, I think we got time for one more question here. Let's see what we got. Okay, so someone asked, with the current environment, like with regulatory changing, like how do we handle that? It's a super good question. Like I actually really like this question because it is incredibly unclear and it's a really tough place to be. Essentially, like you need to build up your tooling in such a way that you are able to kind of respond to changes. And so for us, that means that we kind of do a treatment method where we sort of pick an accounting treatment, but then you run your taxes kind of retrospectively on our treatments, and then that generates your tax reports. So that gives you a nice situation where you can actually, if you need to go back and like, let's say they decide that you were using cost averaging, which is a methodology we support, and then you decided you need to move over to Spec ID, you then just have to kind of go back and re-close your books with that methodology. But we as a vendor tend to build our stuff like kind of intelligently to design. We try to build our stuff intelligently to actually be able to handle that kind of retrospective thing. There's no good answer. Like if some guidance comes out on how you need to be doing fair market valuation and it's different than the way you are doing it, then you are SOL and you just need to go back and redo it all. I mean, it's like one of those kind of tricky things on that side. So I think that's all the time we have today. You guys, you were a absolutely spectacular audience. Thank you so much for all your questions. Thank you so much for attending today. Last thing I'll mention is we have the next webinar in the series, which is how to help your finance team thrive with digital assets. It's coming on December 7th. There, you can follow us on Twitter or anywhere else and get access to all of that. Super fun. Thank you so much. Have an absolutely wonderful day, everybody.